Hello, and welcome to our financial accounting class. I'm Professor Hank. Oh, look, here comes our first student.
Hi, Professor Hank.
Today we're tackling Chapter 5, Merchandising Operations. Let's fetch some accounting wisdom. Unlike service businesses, merchandising companies buy products and resell them. They don't create the goods, they just sell them. Think of it like a dog bakery where biscuits to sell at the park. A service company provides activities like grooming, while a merchant sells physical items like toys or treats. The key difference? Inventory. Let's continue. The operating cycle is the time it takes from buying inventory to getting paid for it. Merchandisers need to track how long they hold on to products and how fast they turn them into cash. Question for the class. Who can tell me the difference between perpetual and periodic inventory systems? Yes, Mater.
With the perpetual inventory system, inventory is updated continuously after each sale. Like a treat jar, you count every time you take a treat. A periodic system updates occasionally, say every month.
Thanks. What a delicious example. Perfect timing. In this case, payment has been made, so we record the inventory as a debit and credit cash. However, most of the time, a company will buy merchandise on account. It then records the inventory as a debit and credit accounts payable. Inventory is an asset like treats in storage. The total inventory cost includes purchase price, shipping if the buyer pays, and any handling fees. All of this gets added to the inventory account. FOB, or free on board. Tell us who owns the goods during shipping. If it's FOB shipping point, the buyer owns them once they leave the seller. They are responsible for the shipping cost. If it's FOB destination, the seller owns them until delivery, and they will pay the shipping costs. Sales have two parts. First, we record the revenue, then we record the cost of what was sold. This keeps our inventory accurate and tells us how much we're earning. In a perpetual system, each sale reduces inventory and records revenue in real time. Sometimes customers return items. These reduce revenue and are recorded as a contra revenue account, meaning they subtract from sales. Sales discounts reward early payment. 2/10 and /30 means 2% off if paid within 10 days, full payment due in 30 days. When expected inventory is higher than what's physically counted, we record the difference as inventory shrinkage. This could be from damage, theft, or miscounting. We adjust for shrinkage by reducing inventory and recording our expenses. Just like adjusting for a treat that's mysteriously disappeared. Multi-step income statements show gross profit, operating income, and net income. Single-step statements just subtract total expenses from total revenues. Merchandisers often prefer multi-step format. It breaks down the profit margins, especially when tracking inventory costs and returns. Gross profit equals sales revenue minus cost of goods sold. This margin tells us how efficiently we turn sales into profit after paying for goods. A high margin means more treat money. In merchandising, inventory is listed as a current asset and what we plan to sell in the short term to make income. At the end of the period, we close sales, costs of goods sold, and expense accounts into income summaries, just like finishing a report before nap time. Congratulations! You've mastered the merchandising cycle.
Thanks for learning with us. Remember, whether you're purring or panting, accounting keeps your business standing.